What's the date today?
28th, maybe 27th.
Good morning. Welcome to the special council meeting for April the 27th. We're dealing with financials today, and we have some guests this morning. Welcome. Thank you very much for coming. And our acting CEO, Betty, I'll pass it to you.
Thank you. So the only agenda item we've got today is presenting the 2025 audited financial statements. So our auditors, James Wade and Amanda Mix, are here, and they're going to go through the statements first or talk about their audit opinion. And then Deborah Bodner and I will go through the financial statements and provide details.
Okay.
So go ahead. Thank you.
Good morning.
Good morning.
I guess first I'd like to thank Betty, Deborah, and the town staff for the cooperation and assistance throughout the audit. One of the things that has made this audit, mostly enjoyable over the years, or the years that it has been, is that, when we're able to work with the town and the staff, and it's applicable, and it's more of than us just checking to make sure that you're following your policies, but also making it's nice when it's we're working together with you guys, and that seems to have established again over the last year or two, where for a while there we were more just the auditors of somebody who wasn't even the town per se, because there were such changes in that period of time. And one of the things I've never said here is that I wanted to always appreciate Dean, who may not be here today, because when he came in when this was a disaster, he came in and really fixed it. And so I know I've never said that but back at our office, and we have lots of information showing that in the last 3 or 4 years, the financial department has really cleaned up and a lot easier for us to deal with than it was for a period of time. So I know it has to do with this one, but I would like to appreciate Dean for that. And I know he doesn't get all the recognition he deserves sometimes, but that's something I know for sure, that he and Betty came in and fixed this to this position now where we can audit it, and it's normal to audit again. Okay. Sorry. The purpose of this audit, purpose of any audit, is as external auditors to express an opinion on whether the town statements are presented fairly, prepared in accordance with public sector accounting standards. We conduct our audit in accordance with auditing standards, which require us to plan, perform our work to obtain reasonable assurance that the financial statements are free from material misstatement, whether or not they were due to fraud or just error. The auditor report is prepared for council's management, the province, and the town's ratepayers. The roles and responsibilities: manager is responsible for preparing the financial statements, maintaining internal controls, safeguarding town assets, and providing us with the information needed to complete the audit. Council are those charged with governance. Its responsibility overseeing the financial reporting process, reviewing the financial statements, and approving them prior to issuance. Our role is limited to providing an independent assurance, as the auditor does not replace management or council's responsibility, but giving opinion on the information. And the reason I stress that is because it's been such a problem for all, public and industries and accountants over the year, that there's a kind of a gap of what we really do and what we're supposed to be doing. So that's why I kind of say, hey, ours is really giving an opinion. The results: manager cooperated fully with the audit. We had no unresolved disagreements. We are not made aware of any illegal or fraud based on our work. We did not identify any evidence of possible fraud or illegal acts. We'll issue a management letter with recommendations to assist the town in strengthening the internal controls. Any significant matters we would report directly to council, but we have nothing that we view significant enough other than bookkeeping and internal control issues. Betty will provide a more detailed review on a high-level perspective, but I'll kind of just give a quick little blurb. When you quick look at the statements, you can see that your cash and investments has increased, which again is something always to note where you're at. So in the last few years, you've been acquiring kind of cash because of all the capital projects that have happened, but still knowing that even though we've spent lots on capital projects, we are still healthy for between the cash and investments. Very similar to last year, I think 34.5, 35 combined. Your accumulated surplus increased to 143 million, or from 140.3 million to 153 million. And again, when we're going to flip to one of the pages here, I want to show you kind of, if you flip to, I don't know, maybe it's page 6. It's the schedule of accumulated operating surplus. So if you look at this sheet where it has your unrestricted surplus, your restricted surplus, your equity and capital assets, and then your total. And so that's a really good sheet to look at, because when you first look at the unrestricted, you see all the things that go into basically all your operations. And then from there, we move things to your different kind of equity categories. So when we look at your restricted surplus, restricted reserves, which is $29 million, and then you have some amounts coming in and out, and those are over all your reserves, or the town's reserves. And so they start at 29.4 million, a little few adjustments, and you end up with 30.2 at the end, and that's really what you've set aside for your restricted reserves. The equity and tangible capital assets is kind of the total value or historical cost of all your property, plant, and equipment, your TCA. And it, again, if you go in any one of those, you can see that it's throwing categories and items that affect your net amount. So you go from 108 to 119, and that includes the depreciation and the addition of all the new stuff. But really, when you're looking at the town, you see that it has $120 million of capital assets. It has $30 million set aside for reserves and your external reserves, and then it has $3 million worth of unrestricted surplus. So I think that's always a good way to look at it. And what is the town, where is that right now? That's what it is. Anyway, that's really all I have, and if you have specific questions, I'm more than happy to answer. Eventually, we'll need a motion for the council to approve these statements, whether it's shortly or later today or whenever, but before we finalize them, it will have to be. And that's really it, unless there's questions.
Okay, thank you. Councillor Shipple.
Thank you, Mayor Boniface. So the water treatment plant is coming on, and it's a substantial amount of money. And so when you talk about capital assets, that water treatment plant, portions of that are paid for by government grants, other governments, including County of Clearwater. Do we capture the whole amount as a town, although we don't pay for the whole amount? Or do we just capture the amount that we pay for that water treatment plant?
So how it works is most of the time you'll get all your funding, which will go through the financial statements, and sometimes we'll stick it in a deferred revenue or a capital project or whatever, but it eventually gets moved to when you're paying for it, or we've acquired the asset, so to speak. And so yes, the full amount will be set up.
So we acquire capital assets using other people's money?
Yeah.
Oh, that's a good deal, eh?
No, well, think about it this way, Dale. The government gives you a $5 million grant. It's now yours to spend with it if you do this. And so you buy the asset now for $5 million, but you also had revenue for $500 million, $5 million or whatever.
So where my mind is going is that we have other shared facilities with the county.
Okay.
And so does this...
Shared facilities with the county end up like different. Sometimes you do sharings where, like the airport,
Correct, yes.
where it's split down the middle in that case. And so how it's recorded is different than how the pool, say, is recorded, where you own all that building. Even though they end up giving you some contribution, it's still your pool.
Any other questions?
Do you want more explanation?
No, it just seems like it's not the same for everything, and I'm not sure why it's not the same for everything, but...
Maybe, do you
Yeah,
mind?
go ahead.
I'll just speak to it a little bit. It depends on the agreement, and we're really speaking about between ourselves and the county. And, yeah, we have 3 major places, and the wastewater treatment would be 4th. So fire is a regional fire, and it depends on the wording of the contracts. And we will speak to it here. We pay for a portion, it's not always 50%, of fire equipment. When we give the county funds, we run it through the operating as a grant. So we record absolutely no fire assets. They record them all within the regional fire. So it flows through as a grant. The airport, because it's jointly managed, and again, the wording, we record 1/2 of the assets and the county records 1/2 of the assets. So it's different. With the rec department, we record all of the assets that are recorded by, or done by rec, but the county gives us a grant for 50% of the operation. So yeah, we've got 3 different methodologies. With the wastewater treatment plant, their portion, I mean, it's still a lot, but their portion of the whole wastewater treatment plant was, I mean, smaller in comparison to the full $30 million budget. And it was based on the percentage of, sorry, now I can't think of the word, of effluent that they put into the system. And there was a study done and it was determined what percentage it was. And that's what drives their contribution. But, so as James said, if we get money from other sources, we record it as revenue, and we will talk about grants, capital grants on the income statement, and then we record the full amount of the asset for the wastewater treatment plant. But you're right, there's 3 different methods. I wish there wasn't, I wish there was just one, because it would make life a lot easier, but it's due to the nature of the agreements.
Same way as lots of people, they go buy a vehicle and they get a bank loan for whatever, $30,000, and they have this vehicle and they pay their loan payment every month. And then there's all the people that go and get a leased vehicle, which is, again, and they pay a lease. So it's recorded completely different the whole time, but theoretically the amount of cash they pay out and the expense that'll be recorded is the same over the period of time. It's just how it's set up is a bit different, and so sometimes it happens with your government sharing of the costs.
Is it possible to work towards one common denominator in doing these agreements in the future? Is it a possibility or not a possibility?
I actually wouldn't want to comment on that. I think you would need CAO Kraus involved. Some of it depends on the nature of the agreement, like us giving grant money to the county. Absolutely, I think that's the right way to do it. So you're always going to have some differences depending on what it is that we're funding.
Any further questions? Thank you so much for your presentation today. Certainly appreciate your time. Would Ms. Gillen?
And then Deb and I will go through the statements in more detail now.
Okay.
So, do you guys want to stay for it, or? It's totally your call.
You're welcome. You're welcome to stay with us, but if you, so that, I guess if we have questions, that's fine. So, okay, thank you.
Shane, if I can.
One second. Councillor Schipel.
Yes, in your letter, if I can.
Yes, please.
In your letter under Independent Auditor's Report, okay? And you talk about responsibilities of management and council for the consolidated financial statements, okay? And in there, you make one statement as to what council's job is, and that is the council is responsible for overseeing the town's financial reporting process. I don't understand, as a councillor, what the financial reporting process is per se. So when you put that statement in there, I would like an explanation as to what, as a councillor, my responsibility is, because you talk about what management's is, but I'm not sure what a councillor's is.
Okay, that's a much longer question than normal I'd answer, but I mean, basically there's going to be all aspects of you when you go to your council meetings, and you, like, obviously somebody is responsible for making sure that you look at the financial statements monthly and all the information you look at monthly and who signs the checks. So all of it, all the idea of you is you as the counselors, or in this case, you are responsibility of management and watching management and giving them guidance. So there's probably books on what you're supposed to do, but as a general auditing kind of thing, you're required to make sure they're doing their job. I can give you a much more detailed, and we can add it, but that's a complicated long-term question. Well, go ahead, yeah.
I'll just add to it. So, I mean, governance is the role of council, so just, you pass the budget, so you're the approving authority for us making expenditures and making sure that we're sort of balanced budget, spending fiscally responsibility. We do quarterly financial reporting, so you are getting updates on our activities. And the third thing I think is, well, there's four things. One is making sure that we have the appropriate financial policies in place. And I mean, in the last 5 years, we haven't done a lot, but you know, we've got an expenditure policy, a signing authority policy, we've got a budgeting policy. So making sure we have policies in place that administration and staff need to follow. And then the fourth is reviewing the financial statements and knowing that we've been audited, and we do walk through in a fair amount of detail, but knowing that we've complied with, one, the budget, and two, that we're following generally accepted accounting principles and the PSAB.
That's one of the best questions anybody's ever asked us. It's a good question.
What comes to mind is Gibbons. Not that we're Gibbons, but somehow Gibbons got themselves into a place where I want to make sure we never get ourselves into. And so I think that responsibility right now, Municipal Affairs is saying the council of the day. And I'm going, well, I'm the council of the day. I don't want to be Gibbons.
And I don't know all of the specific details of Gibbons, but I don't think what happened to Gibbons was an administrative decision. I think that was probably a council decision on how they were making possibly, I would assume, capital expenditures. So I think it's probably council deciding on the capital projects, and I don't know if administration was bringing those forward as something that they thought they should do, or if administration advised them not to and they chose to do it anyways. So I think it's probably a back and forth, but I think some of those decisions, would possibly be at the council level.
The other thing is you have to be ready to ask the right questions. Like, it's not in the past, Dale, where we haven't gone in camera and you've asked questions. So I think you need to ask questions as counselors. I mean, if something goes wrong, you guys are going to be, looked at. If you had a CA on your council, they would be looked at and scrutinized even further. So I think the only bad question you guys can ever ask Betty or us or anybody is by not asking. So, I mean, ask questions galore.
I do have questions for Debbie and Betty later, so I'll be waiting.
Let us go through the description, because we may answer several of your questions as we go through the statements. I don't know if we can do this during a presentation, but we do need an adoption of the agenda.
Oh, boy. I am so sorry. I just got busy this morning. My apologies. Can I get someone to make a motion, please, to accept the agenda? Councillor Musker.
Thank you, Mayor. I move that we adopt the agenda for the special council meeting.
Thank you very much. All in favor? Thank you for keeping me on track.
Thank Laura. All right, thank you to the auditors for doing the presentation and for the audit. Again, it's been nice working with them. I mean, this is, I don't know, my 6th or 7th audit. I'd have to count. But it is nice. Everybody sort of knows their role. And yes, we've, I think, come a long way since I first started. For the new counselors, when I first started, they had brought in someone. They did 3 audits in 12 months.
Ooh.
And it was a marathon, and James and company audited back-to-back 3 years of financial statements. So it was, I got to come in on the tail end, so I didn't have to go through that. But anyways, it's always good working with these guys. They're that you've been doing. Oh, wow. Anyways, all right, so we've provided you with several variance analysis, and Deb's going to do the income statement or statement of operations, and I am going to go through all the notes. Probably, we'll see how you're feeling, but just, we've got new council, so I do think it's really important. And there's a lot of really, I think, important information that really tells you a lot about our operations and what we're doing, and that kind of feeds into Councillor Chippold's question. So we are required by the MGA to have an audit and present audited financial statements. And there's several schedules and notes. Overall, I would say that we're still, as I said last year, we're in a strong financial position. We've got good reserve balance and our net financial assets. So assets minus liabilities, we're sitting at 25 million. So, you know, we're in a good, strong, I think, cash position. Non-financial assets, as was mentioned, increased from last year by 10.5 million. The bulk of that is the wastewater treatment plant. Normally, we don't do such big projects, but that is driving it up. It's not complete yet. It's still sitting in work in progress, which is part of your TCA. And overall, and we'll go through it, but the statement of operations shows that the activities have stayed fairly close to budgeted activities. There's a couple larger variances, and we will address those. We also include a budget note. It's at the very end of the statement that reconciles the audited financial statements to the budget. Unfortunately, we still have some differences in how we budget against the statements. I try to make them as close as possible, but there's some things that we include in the budget that aren't included in the same spot in the financial statements. So at the end of the year, if we reconcile and, you know, subtract out non-cash things like amortization or government transfers, which are your capital grants, we've ended up with a surplus of 922,000. I consider that good. Last year we were down in about 300, between 300 and 400. I mean, to be able to budget that close or tight means you just need one kind of unforeseen circumstance to go awry. So having this, and there are some bigger surplus or variances that contributed to this, but to me that's successful on a $24 million budget, and we'll talk about some of the variances. Departments are spending basically at the level that they were approved for. So I'm not going to go through some of the sort of higher level variances, but we'll go into the statements. But the big area where we did generate some surplus was in the protective services area, because RCMP, fire billing, and bylaw were all quite a bit under budget each for different reasons, but either vacancies or the county fire billing, and we will be talking to them this year. They're generating more revenue due to being called out for motor vehicle accidents is on provincial highways. So they're generating about $100,000 a year more than they're budgeting for. It's a hard thing to budget. It also follows accounting principles of being conservative, the lower of your estimate, but it is generating surpluses for us because of what we're budgeting. So with that, I'm going to walk through the statements, and then when we hit the income statement or consolidated statement of operations, Deb will go into that. So if you go to the balance sheet or consolidated statement of financial position, I'm just going to walk through each of the line items just to give you an idea of what they represent.
Which page, Betty?
Oh,
The second bullet,
In the big package, like 37
the
pages.
2025 draft audited financial statement.
Is it out of 46 pages?
I don't have a page
Page
number.
one.
Great.
Oh, page
Up
one.
in the audited statements, it says page 1 up at the top.
Okay.
Page 6 on the.
And it says financial, yeah, maybe.
If you would,
if
please,
you
that would
could.
be great.
That would be great.
Then I don't have to bug you, sir.
Well, no, it's not big at all. I've got the right page. Page 12 out of the 46.
Yeah, it's hard when you got
That's any
different
help
page
to anyone
numbers.
that's looking.
What document are you looking for? I've got page 6 of 37.
Does it say consolidated statement of financial position?
Yeah, December 31st, 2000.
And then financial assets and cash?
There we go.
Oh,
Good.
oh, you're
Okay.
okay.
So there it is up there.
You're on a
Perfect.
different document, it's the same thing.
It probably is, yeah.
So when you look at the first line, it says cash and cash equivalents. So last year we're showing 30 million, and this year we're showing 24. The reason it went down by 5.8 million is because we put an additional 5 million into GICs. So that's just moved from the top line down to the 10 million. Our overall cash has dropped a little bit, and that's partly because we've been expending, wastewater treatment plant is drawing down. Under receivables, we've got 3 categories. We've got taxes receivable, which is our outstanding taxes. They've only changed by $8,000 year over year, so basically it's, it's staying fairly constant. Trade and other receivables actually consists of 3 things. One is our general accounts receivable, utilities receivable, and government receivables. So that's that 5.5 million. Accounts receivable is a little bit higher, so there's just been some additional outstanding receivables. Could be because of, it's coming in. Utilities receivable are also a little bit higher, and government receivables are actually down by $500,000. And again, that's government receivables would be funds from the province, so our LGFF grant, our CCBT grant, and any federal monies that are still outstanding on the wastewater. GST receivables, again, we do monthly GST reporting, and it's just the amounts that are outstanding. It's lower than last year, and that could be, I didn't research why it was lower, but likely just due to timing of payments. And sometimes if we have big GST payments coming in after the fact when we're doing the year end, that'll raise the receivable just because they weren't processed. Land held for resale inventory. So that's showing, well, it's 41,000 higher than last year, and that is the piece of land that we took on from the tax auction. I think it's the one downtown, and it's worth about 41,000. And investments, again, you can see that they're up by $5 million for this year, and we accrued the interest because they come due the end of May. And long-term receivable is now zero. We had a receivable and a payable for the 54th Street development. That was paid out in September of this year. So that we had an agreement with the developer. We did the whole project. They owed a certain portion of the project, and we used a line of credit to fund their portion, and then they paid us, and we paid out the line of credit. And as you see, there's notes attached to just about all of these. I will go through the notes in as much detail as you'd like, but we will touch on each of these individually. So then the next, so basically it's showing that we've got financial assets of 41.7 million. The liabilities, our demand loan is now zero, which I just referenced. Accounts payable and accrued liabilities, they're basically very similar to what they were last year. They're up 240,000. Part of that is our accruals during year end were higher, and we also accrued, I think it was $84,000 for, we got a letter from the RCMP. They're back negotiating the union agreement, and they recommended that we accrue a portion in the event that they settle, so that we've recorded it in the correct year. Accounts payable and tangible capital assets is higher, and most of that's due to the county. We invoice them partway through the year for assets that they're cost sharing on, and then at the end of the year, once we're finalizing the TCA, then we send them another invoice, so it was just higher than it was in the previous year. Employee benefit obligations, again, it's almost the same, it's $8,000 difference. Payroll remittances, I think that one's fairly self-explanatory. That's pretty much income tax that was due at the end of the year. Security deposits, and I do speak to that farther on. It is down from the prior year. And deferred revenue is down by 3.7 million. The bulk of that would be for the wastewater treatment plant. When we started the project, the province was paying us just over $9 million, and they actually advanced the full amount of funds. So we've just about drawn it all down. The federal government doesn't pay us. We have to submit, I think we submit quarterly, and then they pay us our portion. And long-term debt is down. We didn't engage or implement any new long-term debt, so really that's just the principal portion that's been paid down. And the asset retirement obligation, there's two items in that section. One is the closed cell, and we get a calculation from the county where I think they pretty much adjust by inflation, but they look at what the potential post-closure costs are for liability, and I don't remember how many years out it is, if it's 20 or 25 years, but it went up by 142,000. The other asset in there, not asset, liability in there is we have 250,000 for asbestos abatement for this building. And that number was arrived at when we were looking at building a new building, and they gave us an estimate for what it would cost to demolish this building and what the asbestos abatement portion of that would be for this building. Okay, and then the net non-financial assets, so basically there's three items in there. There's our TCA, so as James mentioned, it went up 10 million. We actually added almost 15 million of new assets this year, and then after amortization, and there was some sale and trade of a couple assets, it nets out to 10 million. Inventory for consumption is inventory that we hold that is going to be consumed during the year. Yeah. and prepaid expenses and deposits. So we go through, when we're doing the year end and even during the year, anytime we pay anything that's going to run over a year end, say you prepay for a conference, or if we buy a membership, or there's annual fees in, say, IT for a yearly subscription, we look at that, and only the portion that's up to December 31st is expensed. The rest is put into prepaid expenses, and then on January 1st, we would expense them into the correct accounting year. So that's your statement of financial position. I'm going to turn it over to Deb now. She's going to walk you through the consolidated statement of operations. So that is the next page. And she's also included in the package, we tried to give you a statement that looks like, well, it actually looks like the audited statement, but I'll turn that over to you. Yeah.
Oh, thank you, Betty. Good morning, Council. I'd like to actually start on the statement of operations that I prepared, or did you? Yeah, okay. Sorry, so I don't know what page number that is. Yes, thank you.
It's the third attachment on council's agenda.
Called the statement of operations. So it's pretty much a mirror of page 2 of the consolidated statement of operations in the audited financial statement document. This is similar to our quarterly reporting that we provide to council, where we, starting at the top, we provide the budget, the annual approved budget. We have the total actual expenditures for 2025, a percent column, and then we've got a budget variance. And I've added some notation about favorable and unfavorable. So favorable is without brackets, and unfavorable is with brackets. So that might help to differentiate the types of variances there. And then I've also provided the comparison for 2024 as well as the year-over-year variance. So I'm actually going to zip over to the next page, which is an expansion of this document. So,
The fourth attachment of council's agenda.
thank you. And I apologize, it's a little smaller maybe, but I wanted to keep it to one page. The overall, so our operating revenues are 2.8% higher than our approved budget for operating expenditures by $680,000. And I'll go into each one a little bit more. Our total expenditures for each area, we've underspent. We've underspent the expenditure side by 5.3%, or $1.3 million, for a total excess of revenues over expenditures before capital revenue of nearly $2 million there. If you want to go back to the top, Laura. So starting net taxation, that first top line, we had additional revenues of 0.4%, or nearly $44,000, slightly higher than budget, primarily due to new assessment properties and our increased grants in lieu. We went from 50% to 75% in provincial and federal leased properties, owned properties. I apologize for that. So when we have a provincial owned property, each government decides the amount of grants that they will pay to the municipality in response to property taxes. And so for 2025, that went from 50% to 75%. We budgeted 50%. They paid us 75%. Local improvements, we had an initial billing in 2025. User fees and sales of goods, 2.8% higher than budget, or $185,000, primarily due to our recreation, our fitness. We've had increased demand in that for the last few years, I understand. We had bulk water sales, and those were partially reduced by lower bulk wastewater and solid waste sales. I've included in brackets the approximate values of each of those components. Fines and penalties were down 21.4%, or nearly $58,000. Lower revenues from provincial and bylaw fines, primarily due to timing of those payments, and somewhat from vacancies in our community policing positions. Permits and licenses were up 53.1%, or nearly 83,000. We've had higher building permits over the last few years. Franchise fees were down down 3.5%, or $62,000. We had an increase in our Fortis fees of 1.5%, but we had lower volumes than budget there. Quickly over return on investments, our actual interest rate that we realized was lower than our budgeted rate, for a small variance of $3,000 there. Rentals and leases, we had nearly 19.5% over budget, or $143,000, primarily with our recreation facility rentals. We had a full year of our medical building rental, where we budgeted, I think, only 3/4 of a year there, and increased use of our public lands. Contributions and sponsorships, this was a fairly large variance, $134,000. We had a donation that was provided to us from Helen Hunley for the Bike Park Society of $150,000. We received it, but we held it in our deferred revenues in 2024, and then realized it and paid it out in 2025 to the Bike Park Society, and that's kind of the flow through there. You'll see an offset of that payment down in the expenditure section below. Government transfers, or the operating transfers, were up 4.6%, or $178,000. Primarily, we've got a new provincial recycling program. We received money for our energy manager, and a policing study, and a small grant for a body-worn camera digital evidence management system. Say that really quickly. So we had a total additional revenues of nearly $680,000 over our budget. Onto the expenditure side. Legislative services was overspent by 4.8%, or $18,000, mainly due to our higher election costs than we budgeted for, and increased honorariums due to the number of council-attended events. For administration, over budget by 1.9%, or $42,000. We had higher IT costs there that have been budgeted for and taken care of in 2026. We also had higher legal fees for the town, slightly reduced by salary savings from various vacancies throughout the year. Protective services, fairly large variance of nearly or $499,000, mainly due to staff vacancies throughout 2025, lower RCMP contract costs, lower county transfers for regional fire services, Betty mentioned that earlier, and slightly reduced by higher policing study costs. Operations and expenditures, pretty close to on budget, slightly underspent by $190,000, mainly due to lower salaries and benefits, fleet, roads, various components there. Water was underspent by $110,000. Wastewater treatment, this was a large variance of 34%, or $755,000, mainly due to the wastewater treatment plant still in construction phase, resulting in the budgeted contract was not utilized at nearly $498,000. Plus, we've had some unused infrastructure monies there. And then the debenture interest, while the project is in construction phase, we actually capitalize the interest. And in the budget, it's expensed. Zipping on, I'll go down to Parks and Recreation. Over budget by nearly $210,000. This is primarily due to higher wages and benefits due to the increased demand. And you remember the higher revenues that I talked about in the revenue section there. The flow-through of the Hunley Bike Park donation of $150,000. And then we had an adjustment for our parks consumable inventory. Public health, slightly, because the numbers are a bit smaller, the 12.3%, they were overspent by $15,000 for handicap lift and higher wages and benefits. For a total underspend of our budget of $1.3 million or 5.3%. I'm not going to go in the capital section unless Betty wants me to, capital revenue. Any questions on what I just presented?
Oh, pardon me, Councillor Schipel.
Thank you. The only question I have is with the wastewater treatment plant. Going through these numbers last year, we say because we were 6 months behind, and we're still behind. Are we about a year behind in the operation from the what was perceived as the date of the plant getting functional to what it's going to be functional? What is the length of time from anticipated to reality?
I'm not sure when the original opening date was. We had anticipated that it was, we put in $500,000, which is half of where, so I think we had thought it would, be July 1st. Yeah, it's 10 months, easy. Why the delay, I wouldn't want to speak to that. If it was, it could have been getting parts, because we've all had supply chain issues, but I think Sean or Rob would be better to speak to that. But it's kind of a paper number because we had budgeted higher, so this is showing up as we were under budget, but that's because we're really following regular operations.
Councillor Musker.
Thank you, Mayor. I'm not sure who this question will be for, but it's regarding the franchise fees. So the franchise fees were down by $62,000. And in my mind, it seems that franchise fees would be fairly easy to estimate. And I'm just curious why it's down and why that wasn't anticipated. Thank you.
Franchise fees, we actually receive estimates from both Fortis and ATCO. So they send us spreadsheets where they're forecasting what their consumption is going to be. And that's how we do the budgeting. I was going to say, I can't remember if we've usually been under or over. What would drive a franchise fee, in my mind, is the weather and how economical people are trying to be. If you have a really mild winter or a really not hot summer where people aren't using gas or electricity, it's going to drive your fees down, as well as, how if people are starting to feel like their utility bills are too high, which, I'm sure lots of people do, they may be much more conscious about their consumption of those two products, which would drop our actual revenues down. Because, sorry, just one more thing. What we're receiving is the distribution and transmission fees. So so again, it's how much actually flows through their pipes or wires. So that's but often the weather, you'll see that will drive those numbers.
Okay, thank you. That does explain it. So the franchise fees are based on consumption estimates from the utilities themselves, not at our end as a town. Thank you.
Councillor Stalker.
Thank you, Mayor Boniface. The earlier chart that was up there, The Parks and Rec one, it's down near the bottom of this somewhere. Parks and Recreation there, it says, I'm wondering, there's a reduced by adjustment in the parks, the 78,000. I'm missing that. That was the $78,000 savings? Just the way like the highlighted part is what I was wondering at.
Thank you for the question, Councillor. This was an adjustment. So in 2024, we did not capitalize, we did not set up the inventory for a parks consumable. And so we made an adjustment to that inventory in 2025, which effectively reduced, the adjustment had to reduce the total expenditures in that category for the year. I'm not sure if maybe Amanda can expand on that, or James. But it was basically moving the monies from the income statement into the financial position document.
James, go ahead.
Yeah, so if you looked at the very first page we looked at, the very first page where it said, it was a item, where we have all our non-financial assets. You had financial assets to liabilities, and we had tangible capital assets like 1.27 million, and then inventory consumption went from 88,216. Right? So we went, last year in 2024, we had just about $89,000. Page 1, I think that there's numbers. If you go down there, bottom right, third line from the bottom, keep going on the right hand side, keep going. So you see that 88,338, and now we've got 216. So about $80,000 of that was reclassified to there that wouldn't have been budgeted for, because in the past they just expensed it. Now they're saying, hey, now we have 216 of inventory for consumption. Right, so it'd be, it's kind of, it's recording items that are there, and now we're just saying now we have 200. We probably had close to something last year, but it's such a non-material amount, and how you're accounting that. All it is, in the past, we did it one way, now we're doing it another way. It's a really significant change, but it does create, when you look at one little category, you can see the change of how they're doing it.
The money was already there.
Well, the items
It's
were
ju-
already there. Now,
Sorry.
instead of saying we've spent them and they're gone, we're actually saying, well, geez, we actually still have these inventory
got
for
it. Thank
consumption. And so now they're
I see
there.
why it's there. Got it.
And so that just corresponds to that they've changed kind of the way they've recorded it. It's
Thank
more
you.
accurate now, this year, than it was in the past.
Councillor Shipple.
Thank you, Mayor Boniface. To Councillor Musker's question, and this is to Betty, I think the franchise fees are calculated on a percentage of the bill, not on actual usage. Is that correct? And if it is, then I think what's happened is kilowatt hours and gigajoules have actually came down in cost in the last year, which have a direct impact on what we get for a percentage for franchise fees.
Oh,
And
yeah, that could be as well, yeah.
so,
Okay, any further questions? Okay, please continue.
So this variance analysis compares the total spending from 2025 to 2024. So again, it's the same layout. I've provided the total expenditures for 2025, 2024, and then I've created a column for a variance, favorable or unfavorable, with some variance explanations. So overall, the operating revenues were slightly above 2024 by $220,000. And total expenses were overspent or slightly higher than our 2024 by 3.4%, or nearly $778,000. Yeah. Yeah. So I was just looking at I was just providing sort of an overview of what was happening. And then, so there's a total difference between the 2 years, spending of $557,000. For operating revenues, net taxation was higher by $258,000, $259,000. The municipal rate, tax rate increases and new assessment properties. In our user fees and sales of goods, $758,000 of additional revenues over '24 due to the higher demand for recreation programming and utility rate and consumption increases. Fines and penalties were down or lower than 2024 by nearly 56,000. Permits and licenses, we had lower permits there by nearly $32,000. Franchise fees actually were higher than 2024. And because we had a specific rate increase on our Fortis rate there of 1.5%. Return on investments, we actually had lower revenues there. Our average interest rate for 2025 that we realized was 2.74%. In 2024, it was 5.11. Contributions and sponsorships, 121,000 mainly was that Bike Park Society transfer from the Hunley donation. Government transfers were higher in '25 by nearly 399,000. Primarily, there were a few things in here. We've got that provincial recycling program, the energy manager, and other areas there. The last category there, the other, there was a large variance of nearly $1.2 million, and we received a donation from, a capital donation from Shell for the wastewater treatment plant in 2024 worth $1 million, and that's the difference there. And additionally, Betty was talking earlier about the landfill post-closure liability of an increase of $184,000 there. So total additional revenues over 2024 of $220,000, or 0.9%. Expenses, the legislative services were overspent or different from 2024 by nearly $37,000, mainly the civic election. Administration, higher spending of nearly $56,000. Again, higher differences are the higher IT costs. We are seeing a very challenging environment in our IT area, as everybody likely knows. Protective services, nearly $247,000 there. We had lower county transfers for regional fire. Betty talked about that earlier as well. Salary savings from staff vacancies. And then we had higher policing contract costs. Again, compared to prior years. Moving down to our waste management, we had higher spending of $159,000. This is the provision for the landfill post-closure that we talked about earlier as well. Planning and development overspent by $225,000. We had higher building permit inspections. This was offset by higher revenues. We had the data center study of $17,000. I think council might remember that. And we had lower activities in our promotions, our economic development promotions, and our storefront improvement program. Parks and recreation were higher spending of $472,000. We had the recreation Parks and Recreation Regional Master Plan of $100,000. That was a project in 2025. This Hunley donation of $150,000. The adjustments for the parks consumable inventory, and as well higher amortization. So we've got some additional assets in this area. So we've got some higher amortization costs that really stood out compared to 2024. Culture, nearly higher spending of $50,000. There was an increased grant to the library there, which was the largest expenditure there. Total expenses were higher compared to 2024 of nearly $778,000, or 3.4%, for a net change of revenues over expenses of $557,000. Any questions on what I just presented?
No, looks good. Thank you.
I am going to walk through the notes, and again, probably in more detail than I normally would, but because there's, it's your first year as council, I think it's important because there's a lot of background in the notes, so bear with me. So after the statement of operations, which is what Deb just went through, the next schedule we've got is the consolidated statement of change in net financial assets. So this really is just, I'm not going to walk through it in detail, but it's really showing you what the changes are on the bottom half of the balance sheet, or the TCA, the inventory, and the prepaid expenses. So really it's showing you, if you look at that we had budgeted that we would be spending 15 million on TCA. We only spent 10. So that includes, the acquisition of tangible TCA, 2.5 million. Those are assets that were completed and moved into the TCA. Acquisition of construction and projects, so that's progress. That's items that have not been completed, but once they are, will be moved. So the bulk of that is the wastewater treatment plant. So when next year, you'll probably see a much higher number moving directly into TCA. Contribution of tangible capital assets, that's actually the Browood Road. So when a developer does a subdivision, part of their obligation is they'll build the road, put in the underground utilities, sidewalk, curb, gutter, etc. Once it's done, we wait for a period of 2 years just to make sure that there's no operation or no deficiencies, and then we sign off on it. Once we sign off on it, it becomes our asset, and it's called a contributed asset because we did not pay for it. So we recognize it as revenue in the income statement and then transfer it into our TCA subledger as an asset. So that's what that is. Proceeds on disposal of TCA, we did sell some larger pieces of equipment because we were purchasing replacements. And then the amortization of TCA, that's the amortization. And then the gain on disposal of the assets that we sold. So that kind of shows you what the individual changes are within the TCA. The other two are just so net acquisition of supplies, and actually they're 128 and 135. So that gives you the number that's at the bottom of the, I call it balance sheet, old school. I don't know if we're allowed to call it that or. The next statement, and I'm not going to go through this one, but it's your consolidated statement of cash flows. So really what it does is it goes through every item on the balance sheet. If you look at them and the change year over year, show it. So it's kind of showing you what non-cash items changed and what non-cash charges to operations, what the net changes were. So like I'm looking at increase in long-term receivables down there, 2329. So it's showing that year over year, our receivable went down by 2.3. So it's kind of giving you a breakdown by category of what we actually did during the year. The next page, and this is, James did go through it, is the changes in your accumulated surplus. We really have sort of three major areas that we operate within. One is operations, which is your unrestricted surplus. The other is our transfers to reserves, and then the other is our TCA. So it kind of captures the activity on a global level of what we did. So I'm not going to walk through each one of those, but for instance, unrestricted funds designated for future use, you can see there's a minus in unrestricted and a plus under restricted. So that means we moved $3 million from operations. You know, when you do the budget, you'll see transfers to reserves, and we put them into reserves. So it's just highlighting what the changes are in those three major areas. The next schedule, and again, I'm not going to go through this in detail, but it does break down our tangible capital assets. We have 6 major categories that we group our TCA into. Land improvements, which is permanent structures that can't be moved, so trails would go in there. Buildings, engineering structures, which includes roads, curb gutters, sidewalks, water, sewer, any of your underground structures. Machinery and equipment, which is our big rolling stock, and then we've got vehicles. So those are the major categories that we show, and it's basically breaking out, looks like I don't know if it got cut off. But it's showing you know, of the acquisition of TCA, there's 8 million. So of that, 1.5 million was engineering structures. And we will be bringing you a capital project statement with the March statements, but that would have been sort of any road rehab that we did. A portion of that's probably part of that contributed asset, the road and infrastructure, actually it's probably all of that contributed asset. Vehicles, we spent $317,000 on vehicles. So it kind of shows you where our major expenditures were in TCA. The next schedule, and again, this is why I wanted to go through this. It kind of gives you a little bit more breakdown on the income statement. You just see one line item, net municipal taxes. So you see the $10 million. That's what shows up on the income statement. Here it's giving you a little bit more of a breakdown of what that number constitutes. So overall, we collected $13.4 million in taxes. 3.4 million of that was for education and seniors requisitions, and the rest was ours. Real property tax, linear property was 197. Grants in place of property taxes was 116. I'm going to just comment on that because Deb did reference that. So grants in lieu, any provincially or federally owned buildings, we send them a tax notice. What they pay us is called a grant in lieu. It's probably about 5 years ago, maybe 6. They unilaterally decided they weren't going to pay 100% of their property tax. They unilaterally decided to give us 50%. And you've probably seen that reduction over the years. This last year, they increased it to 75, and actually in this budget year, they've gone back to 100%. So it did put a lot of burden on municipalities because it was not discussed. It was just something that they actually did. And just sort of, you don't get to see the variances, but basically, municipal taxes were 31,000 higher than budget and 251 from last year. So the main increases was the grant in lieu, and the year-over-year change was because of our tax increase. And the next schedule is the schedule of government transfers. So again, this just gives you a little bit more detail if you look at it. So on the income statement, you'll see up on the top of the revenue part, we had $4 million of government transfers. The breakdown is other local governments. That's basically Clearwater County, so they gave us 2.5. The province gave us 1.4 and the federal government 8,400. Under transfers for capital, we received 9.7 million. And again, that's the county paying for anything that they're cost sharing with us on. The province, that would be funds that, that'd be wastewater treatment plant, LGFF, and the CCBT. And the federal government is pretty much the wastewater treatment plant. We had budgeted 3.9 for last year. That's what was, I think, left on that grant. And they've paid us 3.8, so it's just about all paid out now. The next statement is just a summary of expenses, and it's the consolidated statement of expenses by object. So what we do is, we've got two ways we report expenses. One is function, which is, operations, administration, and the other is by type or object. So there's salaries and wages. Salaries were actually 200,000 below budget, and they were higher than last year. Most of it was due to, we had 3 vacancies during the year in bylaw. We had some vacancies in finance over the year, and then we had 1 vacancy, I think, for just about the entire year in recreation. So that's what was driving that. Contracted and general services, if you look at the change in budget and the change year over year, again, $500,000 of that was due to the wastewater treatment plant. Do I see a finger down there?
Councillor Shipple.
Thank you. I found this number really interesting because we budgeted much more, and some of that money made sense with the water treatment plant not getting on track. But even then, the number is still $500,000 more over 2024. So the question is what did we spend $500,000 more on contracted and general services than we did the year prior? How do we know that?
Okay.
Or can we get a summary of that? Or?
Well, I do have an answer for that. So the increase over the prior year is mostly due to one-time projects. So if we go back to the variance analysis, so, and I mean, we could summarize it, but one thing that happens when we do our capital is some things you don't want to capitalize, so we do transfer them to operations. So the policing study is one of them. And we also had some increases in contracted services. And
Regional recreational regional master plan was 100,000.
yeah. So we can go through and pull those out for you, but that's one of the reasons why I do like to budget, and we've debated, we might have an operating list and a capital list, but when you put one-time projects into operations, it creates some big fluctuations that to me hide what your actual operation is doing. It kind of blurs the lines. But yeah, we can absolutely. So when I look at the $1 million that we were over, it was $500,000 was the wastewater treatment plant, and the policing budget was basically $230,000, because that's considered a contract under budget. And there was some contracted services budget, say in operations and utilities. Again, those are hard ones for them to estimate, because it depends on the winter. Like if it's really cold, then sometimes we have way more water breaks. Those kind of things happen when we do the budgeting. And I did convince them to drop their budgets. They kind of try to find that fine line between having enough in there that if something goes wrong, they can cover it, but not so much that they're, over budgeting. And it's a real fine line between doing that. And we can provide you with more detail at a later date if you'd like.
Okay, thank you. I guess we do studies pretty regularly. Every year we do studies, so to say that there'd be a study last year and a study the year before. I think what could be relevant is 1 year versus the other year. So 2024 and 2025, if possibly just a list of
Yeah.
what
no, we
makes sense
can-
there, just so you can compare 1 year to the next. $500,000 in contract and general services is substantial. I know I have like over $300,000 in studies sitting on my desk at my office, so,
Yeah. No, we'll provide that, absolutely. So it basically, it just kind of shows you the groupings in the changes. And amortization was higher this year than last year. The auditors did ask me why, so I went in. And it's higher than last year, and it's actually also higher than budget, because when we do the budget, we run a projection in Diamond, and it projects our amortization, but we have to run it in September, right? So it doesn't include any new assets that are added in the current, in the year. So we have had, I wouldn't say significant, but we have been adding lots of infrastructure. I mean, so it didn't capture those. And then the increase year over year is again because we are on a regular basis adding new assets. So it's gonna keep going up, which in some ways actually is good because it shows that you've got a fairly, young isn't the right word, but a fairly new set of assets. If your amortization was really old, that means that your streets, your infrastructure, is being amortized in really old dollars, so it's gonna be really low. So as it gets higher, that means that we are replacing it on a regular basis. The next schedule is segmented disclosure. Again, I'm not gonna go through it, but it splits it into what I call the divisions. So if you look at it, you can kind of see now, taxes and sort of global revenues are included under general government. But really what it tells me, if you look across the board, is how much of your, kind of your tax dollar is going into these other areas. But I would look at the net revenue before amortization, because amortization is actually it's a non-cash number, so that kind of shows you that, transportation really needed to have $1.7 million worth of tax dollars to support its operation. And we actually provide 2 years of that schedule, so you get the current year as well as the prior year. Okay, and now we're into the notes. So the first note, and again, I'm not gonna go through it in detail, but it kind of outlines some of the basic premises that we use when we're preparing the statements. So, it talks about the basis of accounting, the use of estimates, kind of some of the definitions of how we classify things and why we do it. And it's fairly long. It's very long.
One second, Councilor Boniface.
Betty, when you get to the part of the use of the estimates, you said that for all of this, that you're going to go into just light detail. If you could go into maybe more detail when you get that use of estimates, that would be helpful for me. If you can do that.
Do you guys want to maybe answer that? I'm just looking at, I don't know that we do a lot of estimates.
Okay, I guess what I'm after is some construction that's coming up, hopefully in the near future. How we handle, because like what you'd said about how we we have to ask lots of questions. I guess I don't know enough to ask maybe proper questions, but it's the estimates that are concerning me, that how I manage those estimates, because I've seen in the past that usually the constructions are always over and sometimes by a huge amount, and how much is that
Okay.
on me or?
So this particular note referring to the use of estimates, it's talking about when we estimate amortization in the financial statements. And we use a bunch of, we try to use generally accepted, auditing standards for those rules. And so a lot of times how you treat your cash, how you treat your long-term debt, how you treat certain things have estimal portions. I mean, how much interest is going to be collated. When we're calculating depreciation on these assets is just an estimate of what their reduction of useful life is. So if we go right down to a vehicle, and I mean, there's rates and things that we use, but if they were all, $200 million planes, we would be using something like how many hours of use on the engine, right, is how we come up with the estimate. And so this estimate note has to do with those type of accounting procedures where we're trying to guess, either expenses, useful life of things, those type of estimates, not on. Yeah, no, yours is a valid question, just this use of estimate is when we're picking our accounting procedures, how we're picking and estimating certain things. It's actually one of the things that when we're finished our file, any of these that are pertinent and that are significant, they go to my second partner to review that the estimates I've used are consistent with what we should be using. So it is a super important portion of this, but generally we try to find the rules that, and we used estimates that are, generally accepted for municipalities, and that's more of what that note is relating to.
Okay, thank you.
And half my staff doesn't understand that note. So when you're asking that, I was like, okay, well, this is the first time that question's been asked. It's a good question, but it's difficult to express.
The only other key word that I picked up in this is it talks about contingent assets and liabilities. So if, say, there was a lawsuit and we had to estimate, it wouldn't necessarily be recorded in the statements, but we might have to estimate what we thought the contingent cost of it was. The two estimates that I know of on the balance sheet is our post-closure liability and the cost for the asbestos abatement. We're relying on other professionals to give us those numbers. So we're, I guess, assuming that because, they've got a set of rules that they're following, that those are accurate. They could be different when we actually come to the final time where we're having to expend those funds. So.
The same thing when you have your sick time policy. You've got an estimate in there that we've used, what you guys have done in the past, and history in the past, and other municipalities come up with how much of that is a liability. So with some of your liabilities, they're different as estimates you can involve.
But yeah, good question. I did not know the answer. Okay, so if we go on, we will get to the notes. So note 2, cash and equivalents. I just wanted to touch that the 24 million consists of, we've got a general checking account. We also have, and I think I've spoken to you about it, we've got the MUSH savings account, which is municipalities, universities, schools, and hospitals. That's sort of a group, but ATB has developed a savings account that receives tiered interest rates. I find it excellent. Actually, there was just a notice come out with AMSC, or AB Munis, I guess it is now. They're adopting and promoting it through the ATB to all municipalities, because rather than tying, one of the risks we run into is when you tie your money up in a GIC, and I've had it go both ways, you can, and they're usually non-redeemable, so if you can't redeem them at a fixed interest rate, but you also run the risk that if the interest rates go up, you're going to lose money, or if they go down, then you win. But this rate fluctuates and it's tiered, So, and it is lower than what you get on a GIC, but it also allows us to manage any swings in interest rates. I know a couple years ago, we did lock in some money and interest rates went up, so we probably would have been better off staying. So it's, but anyways, so we do keep, right now at year end, we had 22 million in the MUSH savings account. We do have some investments with the credit union. We keep basically $1 million on deposit with them, I think, just to share some of the taxes receivable. It splits out the difference between current taxes and arrears. I mean, I guess the good news on this is it's gone down. Our tax clerk in the last 5 or 6 years, she has done tremendous amount of work with people. If they get behind, working with them to get them either on agreements or promoting people to go on tips, because that all helps keep our outstanding receivables on taxes down and keeps them current. Trade and other receivables. So this is really a breakdown of all the different receivables that we've got. Again, I don't think there's anything huge in there. The over-under levy, it's not huge, but just so you know, every year we have to pay the school requisitions, so we do our taxes. We have to calculate what we actually paid versus what we collected, and there's always a little bit of a difference. So sitting in there was when we did the calculation, so in 2025, there was a difference of $1,487. So we have to add that on. You'll see it on the tax bylaw. We have to add that on and collect it because the town doesn't want to either pay or benefit from the school requisition. So it does show the other receivables. Investments, we have talked a little bit about that, so we have got 10 million. We will look at this when they come due and try to determine, I mean, if we should put some more in there. Again, it's a tough decision to know whether we think interest rates are going to go up or down, and that's really what your big thing is. And if we think we're going to need the cash, but I know with our position, we probably could put money into there. Long-term receivable, that's all paid. Employee benefit obligations. So it shows you the split, so there is some funds in there for banked time. That would be if people work overtime and they want to bank it and take it off in lieu. Vacation time, that is funds that we will pay out because employees either can take it or if they leave, they get it paid out. Personal time is, again, as he mentioned, that's time that is accrued for, we call it personal leave time, it's not called sick time anymore. But if someone leaves our employment, that is not paid out, so we don't pay that. Security deposits, we had $174,000 in there. And that ranges from, we have recreation deposits, post-house, there's a small damage deposit paid on those, and planning. When someone does a construction, sometimes they have to put a deposit down, and they get it back when the project is done if they meet all of the requirements. If there's any deficiencies, then they'll take that out of there. Deferred revenue, again, we don't recognize grants when we get them, we recognize them when we consume them. So we put, I'll use the provincial grant, the $9 million was in there. Like if you look at the balance, the beginning of the year was 4.7, and a lot of that was the provincial grant for the wastewater treatment plant. So we put it into deferred revenue, and then as we use it, it's recognized and brought into actual revenue. And down at the bottom, it shows you what the balance is. So In 2024, yeah, there was 3.4 million of provincial monies, and now at the end of 2025, we've only got 900,000, so that's why it's dropped so significantly. Long-term debt,
Betty, one
Oh.
second, please. Counselor Stalker.
Thank you, Mayor. I just had a question, Betty, about the deferred capital, that 416, yes, we're on the right page, 416, is that carried over into 26? Like, I assume that's the surplus.
sorry, what number?
On the screen, the 416, the other deferred capital revenues, and it says 416, is that put into the reserves, or is that?
No, that's just, it's capital money that we've received
Yes.
that hasn't been spent yet, so it's sitting as a liability, because technically if we didn't spend it, we would have to give it back. So it's sitting as a liability, and then as that is consumed, we will draw that down, and it'll show as revenue.
So then it is carried over into 216, or,
Yeah,
sorry,
yeah,
to
yeah.
26, that's all.
Absolutely, yes,
Okay, I just
yes.
didn't know where that was indicated, but I assumed it must be. Okay.
So if you look at that, we had 566 last year. See that 150? That's the Helen Hunley Fund. So we received
Yes.
those funds from the Helen Hunley Foundation previous years, and then she authorized that we were gonna, so that's taking it out. So it's reducing this balance, and it's showing up on the income statement as revenue.
So if I may, lots of times you'll have your deferred revenue, which are externally restricted, right? So you can't spend those monies based on somebody else's ideas. That's how it ends up in deferred revenue. Then when we got the approval of the 150, that's why there's 416. You also have your internally restricted funds that go through the financial statements, and they end up in your restricted surpluses. And so people get confused with the two of them, because they're both set aside for certain funds, or for certain projects, but you set aside the reserves, and you restrict them. This is somebody else restricting what you're supposed to spend the money on, and that's why it stays in deferred and doesn't go through yet until their conditions have been met.
So I'll just have another question for Betty then. So with that said, that 416 has been deferred into 2026, and I just don't want to lose it somewhere. I assume we have those projects identified, or the money's been identified for a location, and it will be spent on whatever it
Yes,
was given
yeah,
to us for. That's
and,
it.
yeah,
all I
James
was-
is right. It's there because whatever conditions to spend it have not been met yet, so it sits in the liability. No, it won't go anywhere.
It's one of the most reviewed items by us, by them. Because it's so easily manipulated, it gets reviewed and looked at in its entirety. Be rest assured that lots of people would find out it's not gonna go missing.
I didn't want it to go missing. I just
It's
didn't
not-
want
no,
it.
You're doing your steward, you're watching the money, that's good.
I didn't want it to go missing. I just didn't want it to go back.
If you looked at last year's statements, the $1 million that Deb referenced that was received from Shell, we received that a number of years ago. It's been sitting in deferred revenue for a number of years, and then when we spend it, then it comes out. So, yeah, no, we don't.
Sure. Betty, would you mind if I called a 5-minute break?
Oh, no, absolutely.
I'd like to call a 5-minute break at this time, please. Thank you.
Can assume we have
This washer maybe.
lagging, but we're online.
Perfect, thank you. Please continue.
All right. And I might have to repeat this when Councillor Schippel returns, because he did have this question last year. So, long-term debt, it shows you a breakdown. There's three main categories of long-term debt. Most of it's debentures that we have. One is the Green Municipal Fund loan, which is actually our SEEP program. So that is self-supporting. But debentures are split between two different categories. One is tax. Okay, I'm gonna just wait till he comes in. So debentures are split between two categories. One is tax-supported debentures and one is self-supported. The difference being self-supported is when it is funding a utility project, because utilities are self-supporting, so they're not being paid with tax dollars. The tax-supported debentures are anything else, and they are being supported with tax dollars. And yeah, so that's the difference. Okay, and then the asset retirement obligations, I have spoken to those briefly, so that's our post-closure liability, which will carry on for a while. 2037 is when they're looking at, we will finally be able to resolve the post-closure. And then the asbestos abatement. The next schedule is your debt limits and debt servicing. So I know I've had conversations with council about this. The MGA specifies limits on how much you're allowed to borrow. So it's 1.5 times your municipal revenue, which turns out and it changes every year with your revenues, but is basically 39.5 million. We've got debt of 7.3, so you have available to yourselves 32 million. Now, if you got that high, the municipal government would probably phone and say, why are you, what are you doing this for? It also looks at your debt servicing, so the maximum amount of debt servicing or loan payments that you could have would be 6.5 million. We're at 863,000, so you have room in your of 5.7 million. And then again, this one is equity and tangible capital assets. So it's just showing you the TCA less the different things that arrive at the net TCA. So it's less your amortization. Debt is always attributable usually against the asset, so we subtract the amount of debt. It's like saying, I have $5,000 of net equity in my vehicle because I still owe X. And then again, the next one, accumulated surplus, it's just showing you what it consists of. So if you look at that, we've got 3 million in unrestricted surplus. Capital reserves, we have 20 million. Utility reserves, we've got 9.4. And off-site levy reserves, we've got 721. And then our equity in TCA. As far as trust funds, we have two now. So one is the perpetual care from the cemetery that just sits and accrues interest. And I'm not quite sure when you ever would spend it. Our policy says we could if we're doing maintenance, but typically, in my mind, you would maintain that. In the event that the municipality ever stopped existing, those funds would sit there for whatever new organization was to take over to maintain the cemetery. And we also have funds that are held in trust for the tax sale property that we took on. We're unable to locate the owner, so those funds sit in, and I did look it up, I think it's for 15 years. It's 10 or 15 years that they sit in trust. And at the end of that time, if the person has never come forward and asked to be paid those, then the town would close this out and take the funds back. And then we have a note on contractual rights and obligations. So this just kind of outlines some of the things that we have entered into agreements with. So the Football Association, there's a loan that they have on hand with us, so they're paying us $5,200 a year. We also have one with the curling club, and it lists out what they're paying per year. And there's a new agreement, to December 25. That's the community support grant. We changed the nature of that grant. It was based on the net of properties between the two, and we've changed that now, so it's a fixed amount that's just going to be increased. And then the last one is the RCMP contract. So we got $425,000 in 2025. That breaks down, we got three components. One is we get $354,000 for our annual operations, plus we received a $60,000 grant for the policing study, and we received funds for the body cameras. And we have no lawsuits against the town. Note 18 is the salary and benefit disclosure. This is required. So every year we list, and this year it's a big list because it's past and current council. So we list what councilors' salaries and benefits are for the year, as well as the CAO. And then we've got a couple notes left. So the LAPP, this is just describing our pension plan. Oh,
1 second. Councillor Schiffel.
So Betty, just now with Bill 28 becoming law with the people, employees that earn more than 130,000 per year, is this where this will show up, is in the financial statement as well, or how is it laid out?
I'm not exactly sure where it's going to show up. I don't know if we'll be required to put it in the statements. I haven't looked at it in detail. It may be a list that we have to post on our website. And I know BC, they do consolidated lists of all municipalities, so I don't know if the province will be doing that, but it will be posted somewhere. The next note basically just describes the pension plan that we have and shows the amounts. It's a two-tiered system. Actually, in 2026, it went down, I believe, which is lovely. Contaminated site liability, we don't have any that we have to identify any financial liabilities for. Talks about segmented disclosure, so it's really just describing it. And then the last, couple more notes. We show a budget reconciliation, which we kind of addressed in the briefing note, but it's just walking you from the audited statements through to the budget so that you can see, what the changes are. Comparative figures, sometimes they do change comparative figures. If we regroup something a little different, we'll change them. And the budget amounts, the auditors do not audit those. We provide them with the numbers that were approved by council, plus any changes during the year, and that's what they use. And then we talk about, there is a note on financial instruments. It's just describing the different kind of risks that an organization faces. And that is a walkthrough of the financial statements. Thank you for bearing with me while I went through them. But I do think there's a lot of information in the notes, and especially for a new council, and because it is your due diligence, that you go through them and sort of understand what's captured in them.
Thank you. Councillor Stalker.
Thank you, Mayor Boniface. Betty, I just had a question, and I don't think it fits in this budgeting, but I don't want to lose it somewhere along the way. This post-closure liability associated with the dump, I think I'd asked before, is there an end date on that where they give us a certificate that tells us? And I saw it, like it varies by the amount of water we get and all sorts of things. I mean, is there an end date to that we can get it off the books and not have to plan?
Basically, it would be 2037.
Oh, okay.
Now, we do have a matching amount in reserves. We've got, like, when we closed out the regional waste management, we divvied up the assets, and the monies that we got, we put a matching amount in the reserve to pay that liability if we have to. So we usually adjust that accordingly, because we don't want to, at the end of that, say we had to pay 1.5 million, we don't want to have to come up with 1.5 million. So it's matched.
So I believe that you have requirements to watch it till 2061. It's a while.
Oh, right, okay. So a long, long time.
I'd like the first answer better, by the way, but. Thank you. 61, okay.
Councillor Musker.
Thank you, Mayor.
Yeah,
Betty, I don't know if you can speak to this, but what is the history on that monitoring of, on the post-closure thing? Why is this an ongoing financial cost to the town?
Anytime you close a regional land, or a landfill, you would have these requirements. We do have another closed one. In this case, I believe there is contaminated goods that were put in there. So there is, depending on the rainfall, there is leakage. And then we actually have two costs. We have cleanup that's done on a yearly basis. This year it was like 42,000. And then there's an estimate on what the future. So back in, I'm not,
60s?
no, it wasn't in the 60s.
Are you talking new landfill or the old dump?
The one that, the post-closure liability, we took contaminated products and put them in the landfill.
So the old landfill, or the new landfill sites that are 30 kilometers out of town, they've got they're clay-lined pits in there. And all the runoff, the residue from that, the leachate, that has to get treated out of those things. They're designed to run into a pond, and they have to get treated appropriately. The other liability lies with the one that's out by the by the historical park. And that historical park is the one I think we're on the line for 61 years, because there was never a line in there. It was a hole in the ground, and everything got burnt and everything got done in there. And I believe that's the one that is holding us up, because we don't know what's buried in there. So. Does that answer your question? I don't know if it does. It does.
Okay. Is there any other questions arising from the report, please? No. Well, thank you very much. It certainly explained a lot of things. Councillor Shipple.
Hi, Mr. Mayor. I was pretty excited today, because a lot of my questions that I had when I went through it were answered in the end, and to what Betty went through. So I appreciate that effort and the work, and it was good. And we won an award, which really shows how good it's been done. So to that, I'd make the motion that we accept the 2005 audited financial statement for the town of Rocky Mountain House as presented.
Thank you. Any discussion? Seeing none, I will call that to a vote. All in favor? And that is carried. Thank you very much, and thank you for coming today and answering questions.
Thank you very much, appreciate it. Copies you guys have are slightly different than the last copy
Okay.
that you got. So I would collect all those, because they're going to be slightly different.
Is it just the note, or?
Yeah, the number shouldn't have changed.
Okay, there's just one note that got taken out, so.
Yep.
Do you have signatures that the mayor has to do? So are we gonna go into closed session now? And
Yep.
then could we get the statements signed off? if
Yes.
Possible? Awesome, thank you.
Okay. Seeing how there's nothing further, and we do have a closed session today, may I have a motion to go into closed session, please? Councillor Sinclair.
I'll make the motion that we move into closed session.
Good. All in favor? And that is carried. Thank you very much. Yeah, you better.
We are live again.
Thank you. We're out of closed session. We do have one motion. Counselor Sinclair.
I'll make the motion that we accept item 4.2 for information purposes.
Thank you. Any discussion? Seeing none, all in favor, and that is carried. Thank you very much for being with us today, and we'll see you at our next